For a growing number of people, the strain of everyday life does not arrive as a crisis. It does not come with a single dramatic event or an obvious breaking point. Instead, it arrives quietly, almost invisibly, through the slow accumulation of small pressures that change how each month feels. Life continues on the surface. Work continues. Bills are paid. Routines remain intact. Yet something underneath has shifted, and it is felt more than it is seen. The most confusing part is that nothing appears obviously wrong. Income still comes in. Employment still exists. There is no sudden collapse to point to. From the outside, life looks stable, but from the inside, it feels increasingly narrow. The margin that once existed between getting by and falling behind has thinned. The room to absorb surprises has shrunk. What used to feel manageable now feels tight. This is why so many people struggle to explain their stress. They cannot point to a single problem. Instead, they describe a general sense of pressure. Groceries cost more than they used to. Insurance premiums quietly rose and never came back down. Utilities take a bigger share of the paycheck. Medical bills appear more often and feel harder to absorb. None of these alone create panic. Together, they change the emotional texture of everyday life. Month by month, decisions begin to feel heavier. An unexpected expense no longer feels like an inconvenience. It becomes a choice. Something else must be delayed. Something else must wait. The household is not failing. It is adjusting, but adjustment itself has a cost. It consumes attention, energy, and emotional bandwidth. What makes this period particularly disorienting is the disconnect between personal experience and public narrative. Economic headlines continue to emphasize resilience. Growth remains positive. Employment levels appear strong. From a distance, the system looks functional, yet lived experience tells a more complicated story. Stability on paper does not always translate to stability at home. This gap between data and daily life is where confusion grows. People hear that the economy is doing fine, yet they feel increasingly stretched. They wonder whether the problem is personal. They question their own decisions. But the pattern is too widespread to be individual failure. Something structural has changed in how households operate. The pressure most people feel today is not driven by sudden loss. It is driven by erosion. Financial breathing room has been slowly eaten away by costs that rise faster than income. Housing remains expensive. Transportation costs remain elevated. Healthcare remains unpredictable. Even services that once felt routine now demand more attention and money. For years, many households relied on buffers built in earlier periods. Savings accumulated. Debt remained manageable. Credit was available, but not essential. Those buffers allowed people to absorb shocks without changing their lives. A car repair did not disrupt the entire month. A higher bill did not force trade-offs. That buffer created a sense of security, even when income was modest. Over time, those buffers have weakened. Savings were drawn down to manage higher costs. Emergency funds shrank. What replaced them was not higher income, but adaptation. Households learned how to stretch. They learned how to delay. They learned how to juggle. This is not reckless behavior. It is survival behavior. People did not suddenly become irresponsible. They responded to an environment that became less forgiving. When costs rise and stay high, households must change how they operate. The adjustment is gradual, and because it is gradual, it often goes unnoticed. The first signs appear in small decisions. Dining out becomes less frequent. Subscriptions are reconsidered. Purchases are delayed. None of this signals crisis. It signals caution. Over time, caution becomes habit. Spending becomes more intentional. Risk tolerance declines. Eventually, credit begins to play a different role. It is no longer just a convenience. It becomes a stabilizer. When expenses exceed what income can comfortably cover, credit absorbs the difference, not because people want it to, but because there is nowhere else for that pressure to go. This shift is especially noticeable among households that would traditionally be considered stable. Middle-income earners often fall into a gap. They do not qualify for assistance. They are expected to manage on their own, yet they face the same rising costs as everyone else. When their buffers erode, the only tool left is borrowing. At first, this feels manageable. Balances rotate. Minimum payments are made. Life continues. The danger is not immediate collapse. The danger is dependence. When debt becomes part of routine expenses, flexibility disappears. Every future dollar of income is partially claimed by past decisions. This changes how households respond to stress. There is less room for error. A late payment becomes more consequential. A small mistake becomes expensive. Budgets become rigid, not because people lack discipline, but because commitments pile up. What makes this phase difficult to recognize is its subtlety. Systems built on thin margins do not break loudly. They strain quietly. They hold together until something small pushes them past a limit that no one realized was there. The emotional impact of this strain is often underestimated. Constant vigilance takes a toll. When every purchase requires calculation, mental fatigue grows. People feel tired without knowing why. They feel anxious without a clear trigger. This is the cost of operating without margin. Over time, this stress reshapes priorities. Long-term planning gives way to short-term management. The future feels harder to think about because the present demands so much attention. Decisions are framed around getting through the month rather than building toward something better. This is not pessimism. It is realism shaped by experience. When households learn that buffers disappear quickly, they become cautious. They delay commitments. They hesitate before taking on new obligations. That hesitation spreads quietly across millions of people. From the outside, nothing looks broken. Stores remain open. Restaurants stay busy. Paychecks still arrive. But beneath that surface activity, something fundamental has changed. The system is no longer running on comfort. It is running on prioritization. Understanding this distinction matters. Activity does not equal health. Motion does not equal stability. An economy can continue to move even as the foundation underneath weakens. The signs do not appear all at once. They accumulate slowly, through behavior rather than headlines. This is the stage we are in now. Not collapse, but compression. Not panic, but strain. A period where life continues, yet feels harder than it should. Where people do everything right and still feel behind. Where the effort required to maintain normalcy quietly increases. This breakdown begins here, not with statistics or forecasts, but with that feeling, the sense that something has changed, even if it is hard to name, before the data catches up, before the headlines shift. The pressure shows up first in lived experience, long before it appears anywhere else. Once households lose financial margin, behavior begins to change in ways that are subtle but powerful. These changes are rarely dramatic. They do not show up as sudden lifestyle shifts or visible hardship. Instead, they appear as small adaptations that slowly become permanent. What begins as a temporary adjustment gradually turns into a new operating mode. At first, most people believe the pressure is short-lived. Costs feel elevated but manageable. The assumption is that income will catch up or that prices will settle back down. During this phase, households rely on flexibility. They postpone purchases. They dip into savings. They tell themselves this is a passing phase, but as months pass, that expectation weakens. Prices stabilize, but at a higher level. Wages rise, but not enough to restore the old balance. The gap between income and expenses does not close. It becomes structural. At that point, Adaptation stops being temporary and starts becoming embedded. This is when credit takes on a new role. It is no longer a bridge between one month and the next. It becomes part of the monthly equation. Credit cards in particular shift from convenience to necessity. They absorb the difference between what life costs and what income comfortably covers. This shift does not happen all at once. It happens transaction by transaction, a grocery bill that runs higher than expected, an insurance premium that increases without warning, a medical expense that cannot be delayed. Each time the card steps in, each time the balance carries forward a little longer. What makes this dangerous is not the existence of debt itself. Debt has always been part of household finance. Mortgages, auto loans, student loans, these have existed for generations. The difference now is how debt is used. It is no longer primarily a tool for building. It is increasingly a tool for maintaining. In earlier periods, borrowing usually followed growth. Income increased first. Then households took on obligations that matched their expanded capacity. Today, that order has reversed for many people. Costs rise first. Income follows slowly, if at all. Debt fills the gap in between. This reversal changes the psychology of borrowing. Debt is no longer associated with optimism or expansion. It is associated with relief. It becomes a pressure valve, something that keeps life functioning when expenses exceed expectations. Over time, that relief turns into reliance. Once reliance sets in, flexibility disappears. Every new balance brings with it future obligations. Minimum payments rise, interest consumes more of each paycheck. The household becomes less responsive to change. When income fluctuates or expenses spike, there is less room to maneuver. This is how systems built on thin margins behave. They appear stable until they are tested. And when they are tested, the consequences are immediate. A late payment carries penalties. A missed bill triggers fees. Small disruptions cascade quickly. What is often overlooked is how widespread this dynamic has become. It is not confined to the lowest income groups. Middle-income households are increasingly affected. These are households that still work, still earn, still appear stable. Yet beneath that appearance, their financial structure has changed. Many of these households once relied on savings accumulated during earlier years. Those savings provided confidence. They allowed people to take risks, to plan ahead, to absorb uncertainty. As costs rose, those savings were used to smooth the transition. Over time, they were depleted. What replaced them was not stronger income growth, but revolving credit. This is a critical shift. Savings create resilience. Credit creates obligation. When savings disappear, households lose their primary shock absorber. What remains is a system that depends on continuity. Continuity becomes essential. Paychecks must arrive on time. Expenses must remain predictable. Any deviation creates stress. This is why households in this position become increasingly cautious. They avoid changes. They resist new commitments. They focus on keeping things steady. This caution shows up in behavior long before it shows up in data. People delay major purchases. They hold on to cars longer. They postpone home improvements. They think twice before traveling. These decisions are not driven by fear. They are driven by experience. Experience teaches households that recovery is harder than it used to be. A setback takes longer to unwind. A balance takes longer to pay down. Mistakes are more expensive. As a result, people become more conservative without consciously deciding to. The danger in this phase is not collapse, it is rigidity. When too much of future income is pre-committed, households lose the ability to adapt. They become vulnerable to shocks, not because they lack income, but because they lack options. This vulnerability is unevenly distributed. Households with low fixed costs retain flexibility. They can adjust spending quickly. Households with high fixed costs have little room to move. Housing, transportation, insurance, and debt payments consume most of their income. Everything else must fit around those obligations. As fixed costs expand, discretionary spending shrinks, but discretionary does not mean unimportant. It includes things that make life enjoyable and sustainable. When those are cut back, quality of life declines even if basic needs are met. Over time, this creates a sense of stagnation. Life feels like maintenance rather than progress. People work to stay in place rather than move forward. This is emotionally draining, even if it does not register as financial crisis. The broader economy feels this shift through behavior rather than statistics. Spending continues, but it becomes more cautious. Growth persists, but it slows. Businesses notice changes in demand patterns. Sales remain, but momentum weakens. Because these changes happen gradually, they are easy to misinterpret. From a distance, everything looks fine. From up close, it feels fragile. That fragility does not announce itself. It accumulates quietly. This is why reliance on debt matters. It does not cause immediate failure. It creates delayed vulnerability. The household can function as long as conditions remain stable. The problem arises when conditions change. When interest rates rise, carrying balances becomes more expensive. When lenders tighten standards, access to credit becomes less reliable. When income fluctuates, obligations remain fixed. The margin for error disappears. At that point, households begin prioritizing. Not everything can be paid at once. Decisions must be made. These decisions are rarely about preference. They are about necessity. Housing comes first. Utilities follow. Food remains essential. What gets pushed back are the obligations with the most flexibility. Credit cards, personal loans, sometimes auto payments. These choices are not a sign of neglect. They are a sign of constraint. This is how financial stress becomes visible, not through dramatic collapse, but through delayed payments, through rising balances, through patterns that repeat quietly across millions of households. By the time these signals appear, the adjustment has already happened. The household has already changed how it operates. The data lags behind behavior, just as headlines lag behind lived experience. This is the stage where dependence becomes clear, not because people stop trying, but because trying is no longer enough to restore margin. The system holds together, but it does so under constant tension. Understanding this dynamic is essential. It explains why stress rises even when employment remains stable. It explains why people feel worse even when numbers look fine. It explains why the current environment feels exhausting rather than catastrophic. This is not a story of failure. It is a story of adaptation that went on too long without relief. And once adaptation becomes dependence, reversing it becomes much harder than it appears. One of the most important changes in household finances over the past several years is not a number most people track directly. It is not a single bill, a single rate, or a single headline statistic. It is the disappearance of financial margin. That margin is the space between stability and stress. It is the difference between absorbing a problem and being disrupted by it. Financial margin shows up in quiet ways. It is the extra money left at the end of the month. It is the savings account that can handle a surprise. It is the ability to adjust without panic. For a long time, many households had some version of this margin, even if it was small. That margin made life feel manageable. When margin exists, problems remain proportional. A car repair is inconvenient, not destabilizing. A higher utility bill is annoying, not threatening. The household absorbs the cost and moves on. This buffer is what allows people to think beyond the present moment. It creates psychological safety as much as financial security. What has changed is not spending behavior in isolation. It is the expansion of fixed costs. Housing consumes a larger share of income than it once did. Insurance premiums have risen and stayed high. Medical expenses have become more frequent and less predictable. Basic services now take up more room in the monthly budget. As fixed costs rise, margin shrinks. This relationship is mechanical. There is nothing emotional about it. When more income is committed before the month begins, less remains available to respond to change. The household becomes less flexible by design. At first, the loss of margin is barely noticeable. Life still functions. Bills are still paid. But the feeling changes. Decisions require more calculation. The end of the month feels closer. The space that once existed quietly disappears. This is where financial stress becomes behavioral. People begin managing cash flow more actively. They track balances more closely. They delay payments strategically. They rotate obligations. These are not signs of irresponsibility. They are signs of adaptation to a tighter system. When margin disappears, time becomes compressed. The household operates in shorter cycles. Instead of thinking in months or years, people think in weeks or pay periods. Long-term planning feels less relevant because short-term stability demands constant attention. This compression changes how households experience risk. Risks that once felt tolerable now feel threatening. A delayed paycheck creates anxiety. A medical appointment becomes a calculation. The system is no longer resilient. It is fragile. Fragility does not mean collapse. It means sensitivity. A fragile system can function for a long time under stable conditions. The problem is that stability cannot be guaranteed. When conditions shift, fragile systems respond quickly and often painfully. This is why the loss of margin matters more than any single debt number. It explains why households feel stressed, even without dramatic events. It explains why small problems now have outsized effects. It explains why life feels harder, even when nothing appears broken. As margin disappears, households begin prioritizing by necessity. Not everything can be addressed at once. Decisions must be made about what gets paid first and what can wait. These decisions are rarely visible from the outside. The prioritization process follows a consistent pattern. Housing is protected as long as possible. Rent or mortgage payments come first. Utilities follow closely. Food remains non-negotiable. Everything else becomes negotiable. Obligations with flexibility are pushed back. Credit cards are paid later. Personal loans are deferred. Sometimes auto payments slip. These are not careless choices. They are deliberate responses to constraint. This is the point where financial stress begins to show up in the data. Delinquencies rise. Late payments increase. But these are not the beginning of the problem. They are the result of a long process that has already unfolded. By the time a household misses a payment, many adjustments have already been made. Spending has been cut. Savings have been used. Credit has been leaned on. Only after those buffers are exhausted does something finally give. This is why delinquencies matter more than dramatic outcomes like bankruptcy or foreclosure. They reveal stress, while households are still trying to hold things together. They are signals of strain, not signs of surrender. What is notable about the current environment is how widespread this behavior has become. It is no longer confined to specific income brackets. Middle-income households are increasingly part of the pattern. These are households that still work, still earn, still participate fully in the economy. This shift matters because it changes the scale of the issue. When financial stress is isolated, the system absorbs it easily. Lenders adjust. Credit scores fluctuate. Life continues. When stress becomes widespread, it becomes systemic. Systemic stress does not announce itself through panic. It spreads quietly through similar decisions made by millions of households at the same time. Each household acts rationally within its constraints. Collectively, those actions change the behavior of the economy. Spending does not collapse. It becomes cautious. Growth does not stop. It slows. Businesses feel the change not through empty stores, but through softer demand and longer sales cycles. Momentum weakens without drama. This is why margin matters. At a macro level, when enough households lose flexibility, the economy loses responsiveness. It becomes less able to absorb shocks. Small disruptions have larger effects because there is less buffer everywhere. The loss of margin also affects confidence, not confidence measured in surveys, but confidence expressed through action. People hesitate. They delay. They avoid commitments. This hesitation shapes economic outcomes over time. Importantly, this process is not driven by fear or pessimism. It is driven by experience. Households learn through repetition that recovery takes longer and costs more than it used to. They adjust accordingly. As this adjustment spreads, it creates a feedback loop. Caution reduces demand. Reduced demand affects income growth. Slower income growth reinforces caution. The system settles into a lower energy state. This does not mean collapse is inevitable. It means progress becomes harder. Growth becomes more fragile. Stability requires more effort. The economy continues to function, but with less room for error. From the outside, this phase is easy to misread. Activity remains visible. Employment remains stable. Headlines remain mixed. But underneath, the foundation is thinner than it appears. Households feel this intuitively. They may not articulate it in economic terms, but they know their margin is gone. They know mistakes are more costly. They know flexibility is limited. This knowledge shapes behavior long before it shows up anywhere else. It changes how people plan, spend, and take risks. It changes how they define security. Understanding the disappearance of margin is essential to understanding the current moment. It explains why stress feels persistent. It explains why relief has not arrived even as inflation slows. It explains why life feels tighter even when numbers look better. This is not a temporary discomfort. It is a structural adjustment that reshaped how households operate. And until margin is restored, either through lower costs, higher income, or reduced obligations, that sense of fragility will remain part of everyday life. For a long time, financial stress remains invisible. It exists inside households, inside conversations that never leave the kitchen table. It shows up in mental calculations, quiet compromises, and postponed plans. From the outside, everything appears normal. This is why the transition from private strain to visible signal is so important. It marks the moment when pressure crosses a threshold. That threshold is rarely dramatic. It is not defined by panic or abandonment. It is defined by prioritization. When households reach the point where not everything can be paid on time, choices must be made. Those choices reveal how stretched the system has become. A missed or late payment is almost never the first adjustment. It is the last one. By the time it happens, a sequence of quieter changes has already occurred. Spending has been trimmed, savings have been tapped, credit has been leaned on more heavily. Only after these options are exhausted does something finally slip. This is why rising delinquencies matter. They are not evidence that people stopped caring. They are evidence that people ran out of flexibility. They show stress while households are still actively trying to hold things together. The pattern of prioritization is remarkably consistent. Housing comes first. Rent or mortgage payments are protected as long as possible. Losing shelter is the most disruptive outcome, and households will sacrifice almost everything else to avoid it. Utilities come next. Electricity, water, heating, and internet are essential to daily functioning. Food follows closely behind. These expenses are non-negotiable. They define the baseline of survival. What gets pushed back are the obligations that offer some degree of flexibility: credit cards, personal loans, sometimes auto payments. These obligations are not unimportant, but they are easier to delay without immediate catastrophe. These decisions are not made casually, they are made under pressure. They involve trade-offs that carry consequences into the future. Late fees accumulate, interest compounds, credit scores decline. But in the moment, the priority is continuity. Keeping life functioning today outweighs abstract future costs. As more households enter this phase, patterns begin to appear. Delinquency rates rise across multiple categories, not all at once, and not evenly. The increase is uneven and gradual, which makes it easy to dismiss, but the breadth matters more than the speed. When delinquencies spread beyond the most vulnerable households, they signal a shift in the underlying structure. Middle-income earners become part of the data. People who are still employed and still earning begin to show signs of strain. This is an important change. In earlier periods, financial stress was often concentrated. Specific groups were affected more than others. The system could absorb that stress without significant disruption. Today, the pressure is more diffuse. Diffuse stress is harder to see and harder to address. It does not create a single crisis point. It creates a slow accumulation of friction. Each household adjusts independently. Collectively, those adjustments change the behavior of the economy. Lenders respond cautiously. Standards tighten quietly. Approval processes become stricter. Limits are reduced or left unchanged. Access to credit becomes less predictable. For households already relying on credit to maintain stability, this creates additional strain. The tool they have been using to absorb shocks becomes less reliable. At the same time, carrying existing balances becomes more expensive. Interest rates amplify this effect. Higher rates increase minimum payments. They slow progress toward paying balances down. They extend the duration of stress. What once felt manageable now feels persistent. This combination creates a feedback loop. Households under strain reduce discretionary spending. Reduced spending affects business revenue. Businesses respond by becoming more cautious. Hiring slows. Wage growth moderates. The original strain is reinforced. None of this happens overnight. There is no clear moment when everything changes. The economy continues to function. Jobs remain. Transactions occur. But the quality of activity shifts. Spending becomes defensive rather than aspirational. Purchases are made to maintain rather than improve. Growth continues, but it is supported by effort rather than ease. This is why surface-level indicators can be misleading. Activity does not equal comfort. Motion does not equal health. An economy can remain busy while households feel exhausted. The visibility of stress increases as more households reach their limits. Late payments become more common. Requests for extensions rise. Conversations about money become more frequent and more strained. Importantly, this stress does not always result in default. Many households continue to juggle successfully for long periods. They rotate obligations. They shift timing. They manage cash flow with precision, but this precision comes at a cost. It requires constant attention. It leaves little room for error. One unexpected expense can unravel months of careful balancing. This fragility changes how people experience time. The future feels less accessible. Planning feels risky. Commitments feel heavier. People become reluctant to take on anything new. This reluctance shows up in behavior long before it appears in data. People delay home purchases. They avoid upgrading vehicles. They hesitate before making long-term commitments. These decisions accumulate quietly. From a system perspective, This behavior reduces momentum. Growth becomes harder to sustain. The economy becomes more sensitive to shocks. Small disruptions have larger effects because buffers are thinner everywhere. What makes this phase challenging is that it lacks drama. There is no single event to point to, no obvious turning point. The stress is real, but it unfolds slowly. This slow unfolding makes it easy to misinterpret. Some people appear unaffected. Others feel constant pressure. Both experiences coexist. This unevenness creates confusion and disagreement about what is really happening. The reality is that financial stress is not evenly distributed. Households with low debt and stable costs retain flexibility. Households with high fixed costs and limited margin feel every shift immediately. This unevenness is why the current environment feels contradictory. Some people are doing fine, others are barely holding on. Both observations are true. As stress becomes more visible, it also becomes more normalized. Late payments are discussed more openly. Credit becomes a routine topic of conversation. The stigma fades, replaced by shared experience. This normalization is not a solution, it is an adaptation. It reflects how common the strain has become. At this stage, the system is no longer operating on surplus. It is operating on prioritization. Choices matter more. Timing matters more. Mistakes carry greater consequences. This does not mean collapse is inevitable. It means resilience is reduced. Recovery becomes harder. Stability requires constant effort. Understanding this phase is essential because it explains why stress can rise even when employment remains strong. It explains why households feel worse even when growth continues. It explains why relief feels elusive. The visibility of stress is not the cause of the problem. It is the signal. It tells us that the adjustment has progressed far enough to show up in behavior and data. What comes next depends on how this strain is resolved. Whether through higher income, lower costs, or reduced obligations, margin must be restored for flexibility to return. Until then, households will continue to prioritize, juggle, and adapt. The system will continue to function, but under tension. This is the stage where pressure is no longer just felt. It is seen. And once it is seen, it becomes harder to ignore, even if it remains uncomfortable to confront. For many households, the pressure they feel today did not come from one sudden change. It came from multiple obligations re-entering a financial picture that had already been stretched thin. These obligations were not new. They were familiar. What changed was the timing. Old commitments returned at a moment when margin was already gone. Student loan payments are a clear example. For years, those payments were paused, reduced, or temporarily removed from household budgets. During that time, life continued to change. Costs rose. Other expenses expanded to fill the space. Budgets adapted around the absence of those payments. When student loan payments resumed, they did not arrive as a fresh shock. They arrived as a reminder. They revealed that the room people thought they had was already used up. For many borrowers, the monthly amount was not overwhelming on its own, but when added to an already tight budget, it forced trade-offs. These trade-offs did not always appear where people expected. Some borrowers continued paying their student loans on time, but leaned harder on credit cards. Others reduced savings. Some delayed other obligations. The pressure moved rather than disappeared. This is how financial strain spreads. One obligation takes priority, and another absorbs the impact. Nothing breaks immediately. The system stretches. Over time, that stretching becomes visible elsewhere. Auto loans followed a similar path. Vehicle prices rose sharply and never fully corrected. Interest rates increased. Monthly payments climbed. For households that rely on a car to work, transportation is not optional. The payment becomes fixed, regardless of what happens to income or other expenses. These higher payments locked in a larger share of monthly income. What might have once been manageable became restrictive. The household had fewer degrees of freedom. Everything else had to fit around that commitment. Insurance costs added another layer. Premiums for auto, home, and health coverage increased and stayed elevated. These increases often arrived quietly, spread out over time. Each one felt manageable. Together, they reshaped budgets. Medical costs added unpredictability. Even households with insurance faced higher deductibles, copays, and out-of-pocket expenses. These costs were harder to plan for. They appeared irregularly, disrupting carefully balanced months. None of these obligations alone caused failure. The problem was accumulation. A student loan payment here, a higher car payment there, rising insurance premiums in the background. Each one reduced margin a little more. As obligations stacked, flexibility disappeared. The household became less able to respond to change. Small disruptions had larger effects. A single unexpected bill could force a payment elsewhere to be delayed. This is why late payments often show up in surprising places. A bill is not delayed because it is unimportant. It is delayed because something else took priority. The household is constantly ranking obligations, deciding which consequences are least damaging in the moment. This prioritization becomes harder as more fixed costs compete for the same income. There are fewer flexible options. More of the budget is locked in before the month begins. What makes this phase particularly difficult is that many of these obligations are tied to basic functioning. Education, transportation, housing, healthcare. These are not luxuries. They are requirements of participation in modern life. As a result, households cannot simply cut them away. They must carry them, even when doing so creates strain. This creates a sense of being trapped, not by poor choices, but by circumstances that evolved over time. This helps explain why financial stress can rise even while employment remains stable. People are working, they are earning, but they are carrying more obligations than their income can comfortably support. The return of old obligations also interacts with higher interest rates. Payments that were once manageable become more expensive. Progress toward paying down balances slows. The duration of stress lengthens. This combination creates a subtle but powerful shift. Households move from recovery mode to maintenance mode. The goal is no longer improvement. It is preservation. Keeping things from getting worse becomes the primary objective. This mindset affects behavior in quiet ways. People avoid taking on new debt, even for productive purposes. They hesitate before making investments in the future. They delay decisions that require long-term commitment. Businesses feel this shift through demand patterns. Customers still exist, but they are more cautious. They prioritize necessities. They postpone discretionary spending. Sales continue, but growth slows. From a macro perspective, this creates an uneven landscape. Some sectors remain strong. Others weaken. The overall picture looks mixed, which makes interpretation difficult. This difficulty is compounded by the fact that many of these pressures operate below the surface of traditional metrics. Employment statistics do not capture debt stacking. GDP does not reflect margin loss. Headline numbers miss the lived reality. The return of obligations exposes the fragility created during earlier adjustments. When buffers were available, households could absorb additional costs. Once those buffers were gone, the same costs became destabilizing. This is why timing matters so much. A payment that would have been manageable 5 years ago feels heavy today. The environment has changed. The rules have shifted. Understanding this helps clarify why stress feels persistent rather than temporary. The issue is not a single bill or a single year. It is the cumulative effect of obligations that arrived faster than income could adjust. As these obligations return and stack, households are forced into constant optimization. They monitor accounts closely. They plan payments strategically. They manage cash flow with precision. This precision is not empowering. It is exhausting. It leaves little room for rest or error. Every decision carries weight. Over time, this exhaustion shapes outlook. People become less optimistic, not because they expect disaster, but because they no longer expect relief. They adjust expectations downward. They accept a tighter normal. This acceptance is rational. It reflects experience. Households have learned that waiting does not restore margin. Costs remain high. Rates remain elevated. Obligations remain fixed. The result is a slow grind. Life continues. Bills are paid, but the effort required remains high. The sense of progress remains low. This grind does not produce headlines. It produces fatigue. It produces caution. It produces a widespread focus on stability over growth. The return of old obligations is a key part of this story. It explains why stress intensified even without new shocks. It explains why households that seemed stable began to struggle. These obligations did not change. The environment around them did. And once that environment shifted, the same commitments carried very different weight. Recognizing this dynamic is essential to understanding the current moment. It shifts the narrative away from blame and toward structure. It highlights how timing, accumulation, and constraint interact. Households are not failing because they made bad choices. They are strained because multiple systems reset at once, leaving less room to adapt. This is not a crisis of irresponsibility. It is a consequence of obligations returning to a landscape that no longer has margin to absorb them. And until that margin is restored, the pressure created by these stacked commitments will continue to shape behavior, decisions, and outcomes in ways that are quiet, persistent, and difficult to escape. One of the most difficult aspects of the current environment is that it does not offer a clear turning point. People often expect economic stress to resolve through a dramatic event, a crash, a recovery, a moment when conditions clearly change. But this phase does not work that way. Instead, it unfolds as a slow grind. In a slow grind, spending does not collapse. It weakens. Households continue to pay for necessities while pulling back on anything optional. Life goes on, but with less ease. Decisions feel heavier. Commitments feel riskier. The energy of expansion gives way to the discipline of maintenance. This is why the moment feels tiring rather than frightening. There is no single shock to respond to. There is only ongoing pressure. People adjust not because they are panicking, but because they are learning what the environment requires. Businesses sense this shift through behavior. Customers are still present, but they are more selective. Sales still occur, but turnover slows. Growth becomes harder to sustain without discounts, incentives, or financing. Hiring reflects this caution. Companies do not stop hiring entirely, but they become more deliberate. Expansion plans are delayed. Investments are reconsidered. Layoffs, when they occur, happen in smaller, uneven waves rather than all at once. This unevenness is a defining feature of the slow grind. Some households remain comfortable. Others feel constant pressure. Both experiences coexist within the same economy. This makes interpretation difficult and disagreement common. What if I told you there are states in America where people still dream about living off-grid, building a cabin? From the outside, the system looks functional. Jobs exist, transactions occur, activity continues. But activity alone does not indicate health. It only indicates motion. The key constraint in this phase is credit. Credit allowed households to smooth the initial shock of rising costs. It supported spending when income lagged, but credit is not infinite. Over time, limits are reached, balances grow, minimum payments rise, As this happens, access becomes less reliable. Lenders grow more selective. Approval standards tighten. Terms become less favorable. The same tool that once provided flexibility becomes harder to use. For households already stretched, this creates a new layer of stress. The fallback option weakens at the same time it is most needed. The system becomes more brittle. This brittleness changes behavior further. People delay decisions not because they are pessimistic, but because they cannot afford mistakes. They avoid commitments that reduce flexibility. They prioritize liquidity over growth. This mindset spreads quietly. Millions of households make similar choices independently. Collectively, those choices slow momentum. Importantly, this slowdown does not feel like failure. It feels like restraint. People are still participating. They are just doing so more carefully. The challenge with this phase is that it rewards patience and realism, not extremes. Blind optimism ignores constraint. Constant fear exaggerates risk. What works is understanding limits and operating within them. What if I told you there are states in America where people still dream about living off-grid, building a cabin, catching rainwater, growing food, disappearing into quiet land? For households, this often means focusing on controllables, reducing high-interest debt where possible, avoiding new obligations unless they clearly improve stability, preserving liquidity when available. Lower fixed costs restore flexibility. Lower debt reduces vulnerability. These changes are not easy, but they create resilience. At the same time, it is important to recognize that individual behavior cannot fully resolve structural pressure. When costs reset higher across housing, healthcare, insurance, and services, households can only adapt so much. This is why the pressure feels persistent. It is not tied to a single event. It is built into the environment. Economic data often lags this reality. Growth numbers reflect activity, not sustainability. Spending can continue even when it is financed by borrowing or driven by necessity. This is why relying solely on surface-level indicators can be misleading. They show what has already happened, not what is building underneath. Households feel the difference intuitively. They know their margin is thinner. They know recovery takes longer. They know stability requires more effort. This awareness shapes decisions long before it appears in statistics. It changes how people plan their lives. It changes how they define success. In this environment, progress looks different. It is less about expansion and more about durability, less about growth and more about endurance. The slow grind does not announce itself as a crisis. It reveals itself through behavior, through caution, through hesitation, through a collective focus on staying even rather than getting ahead. What comes next depends on whether margin is restored. That can happen in several ways. Income can rise faster than costs. Costs can fall or stabilize long enough for households to rebuild buffers. Debt burdens can be reduced. Without some combination of these, the pressure remains. The system continues to function, but under tension. This tension does not mean collapse is inevitable. It means outcomes become more sensitive to shocks. Small disruptions matter more when buffers are thin. Understanding this helps clarify why the moment feels so confusing. The economy is not breaking, but it is straining. Life is not falling apart, but it feels harder than it should. This is not imagined. It is the result of years of adjustment that quietly reduced flexibility. Recognizing that reality is empowering. It shifts the narrative away from blame and toward clarity. It helps people make calmer decisions grounded in constraints rather than headlines. Periods like this reward those who understand the difference between surface stability and underlying strain. They reward patience, caution, and deliberate choices. They do not favor extremes. They do not reward denial or panic. They reward realism. For households, that realism often means acknowledging limits and prioritizing resilience. It means focusing on what can be controlled and accepting what cannot. For the broader system, it means recognizing that strength is not just about growth, but about margin, about the ability to absorb shocks without forcing constant adaptation. The pressure many people feel today is not a failure of effort. It is the consequence of an environment that changed faster than income and habits could adjust. Understanding that does not solve the problem, but it changes how it is approached. It replaces self-blame with context. It replaces confusion with explanation. It replaces confusion with explanation. This moment is not defined by panic. It is defined by adjustment. A long adjustment that reshaped behavior, expectations, and priorities. The slow grind may not produce headlines, but it produces lasting effects. It changes how people live. It changes what they value. It changes how they think about risk and security. And once those changes take hold, they persist longer than many expect. The goal for individuals and systems alike is not to return to an old normal that no longer exists. It is to rebuild margin in whatever form is possible. Margin restores choice. Choice restores flexibility. Flexibility restores resilience. Without margin, life feels fragile even when it looks stable. With margin, stress recedes even when challenges remain. That is the quiet dividing line of this period, not between growth and recession, but between strain and breathing room. Until that breathing room returns, the grind continues. Slowly, quietly, persistently, and understanding that reality is the first step toward navigating it with clarity rather than confusion.